Hello everyone, I'm Pacchia, and this is Bloomberg Law on Demand. My guest today is the one and only Stuart Saft. He is the chair of the real estate department at law firm Dewey LeBoeuf, based here in New York City. And today we're going to be taking a look at real estate in general and the mortgage lending markets. Stuart, great to see you. Thanks for trudging in today on this snowy day in New York.
Well, thank you for having me.
Okay, so lots to talk about whenever you come in. I'm really quite looking forward to this. Let's start with a broad perspective. Where is real estate these days? 4 or 5 months ago, we were talking about a sector mired in recession. Is it still as bad?
It's struggling to get out. The problem is that, as we've discussed before, real estate is an illiquid investment, and without functioning debt markets, it's very hard for real estate to recover. Mm-hmm. So we now have pockets of recovery in various locations in the country, but large segments of the country are still struggling through what we've seen. And in point of fact, there are markets where the prices are still going down.
Right. In the past, we've talked about the divergence between commercial and residential. Is that continuing on its trajectory, or are we starting to see some commonality?
Well, the interesting thing is that through the middle of 2010, we expected that commercial was going to crash similar to what happened to residential. But commercial has managed to struggle through and is now recovering on a much broader front than residential. Residential is still struggling, and it's unlikely now that we'll see that commercial crash.
Mm-hmm. So if we're going to talk about the residential overhang, it's a big segment of the national economy. I guess we have to talk about the GSEs, Fannie and Freddie.
Yes.
What's happening there?
Nothing.
Seems to be just drifting sideways.
There's nothing that's happening.
Are you surprised?
Well, it's hard for politicians, government officials to make decisions because they frequently are afraid to make a mistake. And they also worry about the law of unintended consequences. So whenever you have a situation similar to where we are now, things drift until a solution seems to find a consensus, because nobody wants to make a mistake. This is particularly difficult situation because you can't have a recovery until you make a decision about Fannie and Freddie.
Yeah, that's one of the things I wanted to jump at. Is the media right in making such a big deal about Fannie and Freddie to begin with? Is it really the source of the problem, so to speak?
Well, there are a lot of sources to the problem. Mm-hmm.
But does the media give too much emphasis to it, I guess would be a way to rephrase.
Quite the contrary. I think that there's not enough emphasis being given to it. Even though Fannie and Freddie have continued to lend through this entire crisis, they are regularly changing their lending standards, which makes it very difficult for the market to adjust to it. They also are now being very closely supervised by the government, and so they are very strictly adhering to the regulations that they've set up, and that's really having a difficult, really creating a difficult situation for the market to recover. And since Fannie and Freddie control most of the residential lending at this point...
It's something like 9 out of 10 loans?
That's exactly right, because the securitization market still hasn't recovered. Mm-hmm. These things are all tied together. It's not making a determination on what to do about Fannie and Freddie is just prolonging the crisis.
So I'm going to ask you to put on a hat a regulator would wear. What needs to be done here?
A decision has to be made. I had a proposal that's being considered by the Congressional Committee, in point of fact, to take the role that Fannie and Freddie played and create 12 cooperatives in different parts of the country, each in the same geographical area consisting of the same geographical area as the Federal Reserve banks, and each cooperative would consist of all of the lending institutions in that community, and they would be responsible for buying the loans from housing in that community, and then there would be a master cooperative that would securitize and sell off these loans. The difference with the previous system, when you only had a single Fannie and Freddie, is that none of these 12 cooperatives would be too big to fail. If one of them ran into a problem, if one of them became too aggressive, it would be easy for the regulator, the Federal Housing Administrator, to move one of the other cooperatives into that jurisdiction to keep selling. At the same time, keep buying loans. At the same time, you'd have their combined strength to give some comfort to the market. That is one of many alternatives that are being considered in Washington right now.
What should the government's stance on guaranteeing these obligations be? Lots of debate. I mean, it seems to be a highly politicized question.
That is a fabulous question, and I think that the government really shouldn't be in the business of making certain that these loans are there. I think the implicit or explicit government guarantee is part of what created the problem. Before the government took over Fannie and Freddie in 2008, there was this belief that the federal government had in fact guaranteed Fannie and Freddie's debt, when in fact they didn't. But the market was so certain that they had, that the rates on Fannie and Freddie's paper were similar to the rates on government paper. So people didn't read the real risk of what buying Fannie and Freddie's paper consisted of, because of this belief that there was a guarantee. And I think that guarantee is what made Fannie and Freddie sloppy. I think if you didn't have the guarantee and you had a non-governmental bureau or bureaus running this, they would be required to be far more prudential in making their lending decisions. The other thing that I have recommended in this proposal that's being considered is that the Fannie and Freddie replacements would only buy conforming loans, so that the lending institutions that would be part of each of the cooperative could make other loans if they want, but they'd either have to find another source for selling them, or they'd have to warehouse them. But the Fannie-Freddie replacement would only be making these AAA credit loans and then securitizing them, and the certainty of these safe loans would help fuel the resurgence of the securitization market.
I've also seen talk of a catastrophic risk insurance fund, something like the FDIC has, being set up to kind of protect mortgage originators or lenders from running into trouble. Where do you stand on something like that?
I think that's a fabulous idea. The problem is that, as we saw with the FDIC's insurance fund, in a crisis, they ran out of money. And to a large extent, probably most of the large lending institutions in the country were underwater at one point or another. But because the insurance fund couldn't handle everything that was supposed to occur, the banks went through this process of amending and pretending. They just stretched out the terms of the loan, not to have to deal with the regulators on these parts. And particularly in the housing market, where you're talking about multiple trillions of dollars of debt, there is the fund would be huge, which would create an additional cost. Yes, very much so.
We're talking about numbers in the trillions. Want to switch gears now. Let's talk about Title 14 of Dodd-Frank. We had you on the program some months back. We had an interesting discussion where we basically came out saying that the provisions embodied in that portion of the Dodd-Frank bill would curtail lenders' ability to go out and make residential loans. How has that played out?
Well, we haven't seen any regulations yet under Title 14, or in fact under most of Dodd-Frank.
Right, long rulemaking periods.
I'm not sure that we'll see all the regulations that are due to be produced in the next decade. But that uncertainty is casting a pall on the market. That, and also that's Title 14, which is the Mortgage Reform and Anti-Predatory Lending Act, which places such places such restrictions on lending institutions that my fear was that they would prefer to do business in other segments of the economy than in housing.
Right. I mean, at the end of the day, will securitization of residential mortgage loans be economically viable?
I believe that as a result of Title 14, it's going to be very difficult to restart the securitization market using residential real estate as one of its components. because Title 14 contains such tremendous protections for consumers, because it was intended to be consumer protection legislation, that it places the pools that would hold these loans at great risk. One of the provisions of Title 14 is that the lender has to be certain that the borrower has the wherewithal to repay the loan, not just currently, but going forward. So the question then becomes, how can a lender, or how could a servicer, or how could someone buying the pooled investments be certain that borrowers are going to have the wherewithal to repay the loan in 20 years? Title 14 also contains restrictions on various fees that can be paid. That's fine in 2010 when it was enacted, but because the legislation contains specific percentages, what happens in 2020 when the numbers all change, when what seems like a high interest rate today is a low interest rate then? These things used to be done by the regulators, so there was some flexibility to deal with changing circumstances. Putting it into the legislation makes it next to impossible to deal with. One of the other titles of Dodd-Frank is Title 10, which is the Financial Protection Bureau, which I've also written about. And the problem there is that although in theory it makes a great deal of sense, the problem is that number one, the legislation can affect not just financial institutions, but virtually any institution in the country. It's so broadly written. Right. And that could easily place limitations on the ability to business to grow and produce jobs. And when you get right down to it, what this is all about is how can we produce enough jobs to be able to restart the economy. So
that being said, real quickly, as we go into the rulemaking period for both those provisions, what's the one thing you would hope rulemakers come out with?
What I would hope is that the current Congress, without the pressure of trying to get something accomplished quickly, would go back into the legislation and amend the legislation to come up with something that makes more sense and doesn't treat lending institutions as if they're the mortal enemy. Okay. One of the things that Congress seems to have forgotten in passing this legislation is that the crisis we just came through wasn't just produced by lending institutions. Congress played a big role in it also. And in all of the reports that have been issued, and there was a report issued just yesterday, no mention is made of the pressure that Congress put on various institution regulators and Fannie and Freddie to make loans that they shouldn't have made.
All right. Very good. We're going to have to leave it there for now and see how it goes. Stuart, thank you so much for coming in today.
My pleasure.
All right. That's Stuart Saft. He is the chair of the real estate department at the law firm Dewey LeBoeuf, based here in New York City. If you'd like to learn more about the issues we just discussed today, please check out our offerings on BloombergLaw.com and on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.